Thank you for joining me today. My name is Yusuf Abujaderi, and we're going to be spending a few minutes today talking about what happened in financial markets and the economy around the world in the third quarter of this year, and what we expect to be coming forth in the fourth quarter of this year. We'll be reviewing portfolio performance. We'll certainly be talking about interest rates, inflation, and some of the other things that have dominated headlines over the past few months and really over the course of the year. And we'll start by referencing a famous line from Game of Thrones. It's the title of today's webinar, Winter is Coming. If you're a fan of the show, you're familiar. If you're not, no worries, I'll explain. The phrase winter is coming is meant to be a bit of a call to action, certainly addressing the inevitable. The winter season arrives every year in the fourth quarter of each year. But in using the line in the show, and the reason we've picked it for our title here, it's a call to action in terms of thinking about how to be prepared for what is inevitably coming. We've experienced some challenges in financial markets throughout this year. There may be some more pain ahead, as indicated by Chairman Powell and other members of the Federal Reserve. And that has a lot to do with what the folks at the Fed are doing to combat the beast that is inflation. We'll spend more time talking about that in the latter half of today's presentation. Before we get there, let's start by reviewing what's been happening in financial markets and how it's affected our clients' portfolios. So as we look at portfolio performance over the third quarter, so beginning in the first part of July and going through the end of September, we're showing you a chart here that is tracking the performance of four entities. Yeski Buoy, us, as indicated by the purple line, kind of throughout the chart here. And you can see for the quarter, we were down by about 7%, 8%. In orange, we have the S&P 500, which is an index that tracks the performance of some of the largest companies in the United States, 500 of them to be exact, down about 6% for the quarter. We've got two other lines here. In blue is the All Country World Index. And if you've spent any time with us, you know that we use the All Country World Index as our benchmark, chiefly because it's an index that tracks stock performance around the globe, and we operate a globally diversified portfolio. So we think it's the most appropriate index to use as a benchmark and measure our performance and the success of our portfolio. For the quarter, also down about 7%. And then down at the bottom there, the All Country World Index ex-US. So in other words, an index that tracks stocks around the world, excluding the United States. So we get the measurement of the performance of international companies by looking at the ACWX or ACWX index. So you can see stocks around the globe were down throughout the quarter. US stocks performed better than international stocks. Of course, we employ both in our portfolio, and that's why you see our portfolio's performance ringing in right in the middle between US and international stocks for the quarter. If we burrow a bit more deeply into performance and look at the individual components of our portfolio, you'll see a listing of those funds here on this chart. Again, just focusing on the third quarter of this year. The best performing stocks, as was indicated on the previous slide, were all in the US. So you can see the top four performing investments that we operate in our clients' portfolios, all from the US. What is most encouraging about this slide is that we see small company and value stocks dominating all the other investments in the portfolio. Start at the top. US companies, small US companies, described as value companies, and we'll spend more time talking about value stocks later today, outperformed their more expensive counterparts. You can see the outperformance relative to the broader U.S. small company index. The same being true internationally. International small value companies outperforming their more expensive counterparts. You can see the international small broader index just a couple lines below. Certainly the same being true with value stocks of the large variety internationally. The one place where we didn't see value stocks outperform their more expensive counterparts was in the U.S. large category, the S&P 500, the more broader index, outperforming the value fund that we employ in our clients' portfolios. And that's different from what we've observed throughout the course of the year. And 3 months is a small sample size, so we won't spend too much time focusing on that. So let's zoom out, as is our habit when trying to add a bit of perspective to what we're seeing in the world. If we look at performance year to date, we can see that our portfolio, again, indicated by the blue line, down some 22% through the end of September. When comparing that against the other indices that we have on this chart, we're certainly happy to report that we're ahead of all the different indices against which we compare our performance. The S&P 500 down by a full 1.5 percentage points more than our portfolio. So put another way, our portfolio outperforming the S&P by 1.5 percentage points year to date. Relative to the All Country World Index, our benchmark, we're outperforming by nearly a full 3 percentage points, which is a strong outperformance through 3 quarters of the year. And then ahead of international stocks by nearly 4 percentage points year to date. One of the things to focus on this chart is how the performance of the green line, the All Country World Index ex-US, international stocks, has changed relative to the other components on the chart. International stocks were carrying the day through the first half of the year. You can see the green line basically tracking with or mirroring the performance of our portfolio through the first quarter and ahead of the other major indices throughout the first half of the year, going in through July. In recent months, that's not been the case. There's really no way to predict when different components of financial markets are going to outperform each other. It's one of the reasons why we think operating a globally diversified portfolio makes the most sense. And so although that's changed recently, the outperformance of those international stocks throughout the first half of the year is one of the reasons why our portfolio is so well positioned relative to our benchmarks and stocks in the U.S., even as we go through the third quarter and looking at how performance has unfolded. And so again, we'll burrow in more deeply, and the pattern kind of remains. Small company stocks, value stocks, those have been the stocks that have carried the day throughout 2022. And we're highlighting that, again, if you spend any time with us and heard us talk about our investment philosophy, you know we are tilted in favor of small company stocks and tilted in favor of value stocks. And so when we see investments with the words small or value, or better yet, both, in the heading for the components that we're reviewing in terms of their performance, that's encouraging. And so as you can see on this chart, lots of value at the top of the chart, and a mix of U.S. and international stocks. And again, that harkens back to the outperformance we saw from international stocks earlier in the year. That outperformance was so dramatic that we're still seeing international stocks kind of in the top half of the rankings in terms of components of our portfolio when we're measuring performance year to date. So a bit more about value stocks, because aside from the outperformance of international stocks in the earlier part of this year, the other thing that's really been buoying our portfolio has been the outperformance of value stocks. So why is it that value stocks have been outperforming their more expensive counterparts? We've seen it across the board. The 4 quadrants, if you will, of our portfolio: U.S. large, international large, US small, and international small. 8 of the 10 mutual funds that we employ in our clients' portfolios fit into one of those 4 quadrants. If you were to take the returns of the International Small Value Fund and then subtract the returns from the broader index that captures international stocks, uh, both growth and value, you would see that the value stocks have outperformed by about 5%, as indicated by the bar on the far left of this chart. You would repeat the same exercise for US small stocks, US large stocks, and as we're seeing on the chart here, international large value stocks had the greatest outperformance relative far this year. Why, however? Why are we seeing value stocks outperform so dramatically? It has everything to do with interest rates. The way that stock prices come to be is what investors do is they look at a company or a basket of companies, if you're looking at a mutual fund, and they make an assessment as to how that company or those companies are going to be performing going into the future. If you make an assessment about a company or a basket of companies' future cash flows, future earnings, and choose an interest rate to discount those values into the present so that you can have an understanding or an assessment or a projection about what that company is worth today, interest rates play a chief role in performing that calculation. The higher the interest rate, the more favorable the environment for a value stock, because value stocks prices are more prevalently calculated by looking at nearer term cash flows, whereas growth stocks, the more expensive stocks out there available for buying and selling, their stock price is more focused on cash flows that are coming out further and further into the future. And so the higher the interest rate, the more dramatically those stock prices are affected. And so a portfolio like ours, which tilts in favor of value stocks, is well suited to navigate an environment like the one we're in now, where interest rates are rising, have been rising, will likely continue to rise for the foreseeable future. That bodes well for the performance of our portfolio relative to the rest of stocks out there, the investment options out there. And so we're encouraged by seeing unsurprising results thus far. We expect value stocks to do better in a rising interest rate environment. And again, gratified to be able to report that that's been the case thus far through the first 3 quarters of this year. I'll make one more statement about performance relative to benchmarks and then pivot a bit here and start focusing on inflation. The reason we always are talking about our performance relative to our benchmark is because we want to know how our portfolio is doing in the current environment. If we're ahead of our benchmark in times when the portfolio is decreasing in value, that bodes well for the eventual recovery. We do have full confidence that markets will make a full recovery. It's just a matter of time. Taking fewer losses in the intervening months positions the portfolio that much better for when things ultimately turn around. And so while we are very much aware that winter is coming, we think we've done a good job preparing for that winter throughout the first 3 quarters of this year. And we have an optimistic outlook for how things will be once winter has come and gone. And so as we pivot to talking about some of the economic factors that have been affecting how financial markets have been performing year to date, really the first place that we have to go is to have a discussion about inflation. The most recent CPI reading, or Consumer Price Index reading, was released just a bit ago, earlier today. It came in a bit hotter than expected. Financial markets are not pleased with that information. The expectation was that the trailing 12-month inflation rate, or the rate by which prices have increased over the past year, was going to ring in at 8.1%. The reading was 8.2%. So again, slightly hotter than expected, but still a decrease in the inflation rate for the third consecutive month. Last month's reading was 8.3%. You can see on the chart here that was less than the preceding month and less than the month prior to that. So what we have is 3 straight months of the 12-month inflation rate decreasing, something we've not seen for the past 2 years. We think that's encouraging news, even if markets are reacting a bit violently to the, again, hotter than expected inflation reading. What's been driving those stickier, higher prices? Well, this illustration shows kind of a breakdown over the past few months. We're looking at the summer months, June, July, and August. Let's start with June. The pink area is indicated by the costs of energy. So oil prices, as you might recall earlier this year, in response to the conflict in Ukraine, among other factors, oil prices shot up. They've since come down fairly dramatically in recent months. You can see, although the pink area here in June was the biggest reason for price increases in that month, in the intervening months, as oil prices have come down, energy prices have been actually a factor in driving inflation and rising prices downward over the past few months. Stickier components have been food and shelter, as indicated by the blue and green areas. And so housing prices and the cost of food have continued to be the chief reasons why prices have continued to rise over the past few months. It'll be fascinating to see how that changes. Obviously, with higher interest rates, the cost continues to rise. The old joke in economics is the cure for higher prices is higher prices. People stop spending money or spend less as prices continue to rise. With interest rates continuing to go up, we can expect that the costs of getting into a new home in terms of interest rates will continue to rise, and hopefully that cools the real estate market. And it'll just be fascinating to see how food prices continue to fluctuate over the coming months. There are a number of factors that play into the price of food, too many for us to name and break down here, but certainly something that we'll be keeping an eye on as the months go by. So the question we keep getting from clients is, when will interest rates stop rising? And it's hard to know. We know that they're rising because it's one of the tools that the Federal Reserve can use to combat inflation. Again, when things become more expensive, it provides a disincentive towards spending, which ultimately should help to bring prices down. There's been a lot of talk about what the neutral rate of interest rates is. We haven't quite reached it. You can see here on the chart the neutral rate as it's currently defined, somewhere between 2 and 3%. The federal funds rate continues to rise. It's presently in a range approaching 3%. Once the Federal Reserve gets together again for their next meeting here in a few weeks, it will likely surge past that 3% threshold. And the Fed's going to continue to raise rates until they're comfortable with the trajectory of the inflation rate. Ultimately, those rates will settle and then start to come down to a place of neutrality. And based on how that's currently being defined, that'll be somewhere maybe in the 2 to 3% range. It's likely, however, that rates will exceed that level for some time, again, in an effort to curb inflation and bring those prices down to a place that's more comfortable. So I mentioned that the Fed is getting together again in the first week of November. By then, not only will they have been able to digest today's inflation reading as measured by the Consumer Price Index, they'll also be able to digest the personal consumption and expenditures reading for inflation, which is a different calculation for the inflation rate, and actually the one the Fed emphasizes more in its policy decisions. We know that they've been telegraphing a 0.75% rate hike, 75 basis points of an increase to the federal funds rate. So we can expect the baseline interest rate, that Fed funds rate, to be somewhere between 3.75% and 4% come the first week of November. It'll be interesting to observe in the intervening weeks between today and then whether or not the slightly hotter than expected inflation reading this morning pushes the Fed to be a bit more aggressive in raising rates. As we saw this past June, the reading for inflation came in a bit higher than expected. The Fed had previously been telegraphing a rate hike of 50 basis points or 0.5%, and instead went with a more aggressive 75 basis point or 0.75% increase. Difficult to tell whether or not they'll be more aggressive than expected, but something to keep an eye on in the weeks that follow between now and this first week of November. And then the Fed will get together again in mid-December. Presently, they're expected to raise rates by another 50 basis points or 0.5%. We'll see how things play out between now and then. And then we'll know at that point, at the end of the year, what the baseline interest rate is. Again, current expectations have that pegged around 4.25%, maybe 4.5%. But we'll know a lot more by mid-December, and that will inform ultimately the decisions that the Federal Reserve makes in response to whatever the inflation readings have been between now and then. And so with that, we'll conclude by summarizing what we're watching as the year comes to a close and we continue to monitor our clients' portfolios. There will be more inflation readings. Again, that personal consumption and expenditures reading will come out here in just a couple of weeks for the month of October. Again, December 1st, and again in the latter part of December. The consumer price index those numbers will be released in the first third of November and again in the first half of December. And so you've got the color coding here that we're using, just noting that the Fed will have access to the PCE reading on October 28th as they make their final decisions for how much to raise rates in that November meeting. And then they'll have 3 additional inflation readings, 1 more for PCE, 2 more for CPI, before they make their final decision on interest rate hikes in mid-December. Aside from what the Fed is doing, we've got an eye on midterm elections. We'll see what happens as a result of how folks are voting in the first week of November here, coming up in just a few weeks. And of course, that will inform which parties have control of which houses, and then expectations about potential policy changes in the coming year. And of course, we'll keep an eye on the fallout from the ongoing conflict in Ukraine. Since Russia invaded Ukraine in February of this year, there have been a number of factors that have been affected economically, certainly the humanitarian aspect. But the war has played a role in affecting how things have unfolded in the global economy and in financial markets, and that will continue to be the case. One of the things that folks are focused on right now, we talked about oil prices earlier in this presentation and how they fluctuated earlier in the year. Right now, the focus is on gas prices and the restricted supply of natural gas from Russia to the rest of Europe, how that's going to affect European nations as they prepare and live through this coming winter. We're hoping that it won't be an overly cold winter and that those European nations will be able to get by as comfortably as possible with the present supply of natural gas that'll be available to warm folks' homes throughout the cold months. Again, just another factor that's been dominating headlines as of late. Certainly other things that have been affected by the war, food prices, and so on. And that will continue to be a part of the larger conversation about inflation and, of course, interest rates and how those are being manipulated to combat what has been a higher than comfortable rate of price increases over the past year and change. But those are the things that we've got our eyes on. And again, if we focus on what we were about at the beginning half of this presentation, although it's been a challenging year, We're happy to say that the portfolio, the investments in our clients' accounts that are serving as the fuel for their financial plans, the portfolio has been doing as well as can be expected and outperforming the benchmarks against which we measure its performance. We understand why. We're gratified to be able to report that that's the case. And we remain confident that at some point, things will turn around. And when that happens, our clients' portfolios are well positioned to take full advantage of the recovery, harness growth wherever it emerges in financial markets. And ultimately, we do have full faith that things are going to get better. It's only a matter of time. In the intervening months, we recommend that you continue to keep an eye on what's happening in the world, and then also that you take care of yourself. Um, the winter months provide many reasons to be celebratory. Of course, we had the holiday season, among other reasons to be grateful. And so we encourage you to focus on the positives. Take comfort that your portfolio is doing exactly what it's supposed to be doing. And the Yeski Buoy team is but a phone call away should you need a personal dose of reassurance. Thank you for joining us today. And again, reach out if you have any questions. We'd be happy to talk to you and talk you through anything that you may be thinking about or wondering about. Thank you.